So, in the crypto market of early 2026, we're looking at a real head-scratcher, a paradox that has some of the sharpest traders out there pretty confused. You've got Bitcoin's price taking a hit, while at the same time, more cash is pouring into the crypto world than ever before. What on earth is going on?
Okay, let's break this down, because this is the core of the whole thing. On one side, you have Bitcoin struggling, right? It's testing its lows, down about 25% from its last peak in 2025. But then you look at the other side, and the total supply of stablecoins, the cash of the crypto world, is just exploding to all-time highs. This just isn't how it's supposed to work. Usually when Bitcoin bleeds, money heads for the hills.
And that really brings us to the central mystery we're going to unpack here. For years, a big Bitcoin drop meant a mass exodus of capital. But not this time. The money isn't leaving the building, it's just moving into a different room. So what is the market trying to tell us? What's the real signal? All right, so to solve this puzzle, first things first, we need to figure out exactly why Bitcoin is under so much pressure. Let's diagnose what some are calling a death by 1,000 cuts. It's not just one thing, it's really a mix of 4 key pressures. First up, you've got the Federal Reserve sticking with its higher-for-longer interest rates. That makes holding something like Bitcoin, which doesn't pay a yield, a little less attractive. Then you've got these huge old liquidations from entities that went bust years ago, finally hitting the market. Third, there's a bit of post-halving fatigue. Miners are selling to cover their rising costs. And finally, just plain old psychological burnout is washing out all the traders who were way too leveraged.
And this quote from Edward Carroll at MAC Digital Group just hits the nail on the head. He says, what we're seeing is not a loss of conviction, it's a leverage washout. And that is absolutely crucial. This isn't long-term believers cashing out. No way. This is the short-term speculators, the gamblers with too much debt getting wiped out.
Which, of course, brings us to the classic crypto showdown. Paper hands versus diamond hands. And all the on-chain data is pointing to one thing. It's the paper hands, the folks who get spooked easily, who are doing all the selling right now. Meanwhile, the diamond hands, the long-term believers, are just holding on tight, riding out the storm.
Okay, so we've got a handle on why Bitcoin's price is dipping. Now let's flip to the other, even more interesting side of this paradox. Why is so much cash flooding into crypto's safe rooms, these stablecoins?
And the key concept here, the big idea, is dry powder. It's just a fancy term for cash, in this case stablecoins, that's sitting on the sidelines, waiting and ready to jump on a good investment when the time is right. And right now, that pile of dry powder isn't just big, it's at a record high. That is some serious potential buying power. So let's be crystal clear on this. Capital is not leaving crypto. It's not running back to old-school bank accounts. What we're seeing is a massive strategic rotation. People are moving out of volatile stuff like Bitcoin and parking it in stablecoins, basically waiting in the wings for their next move.
So why is everyone so comfortable just parking billions of dollars here? Well, a huge part of it comes down to regulation. The Clarity Act of 2025 finally created a clear set of rules. It forced issuers to back every single stablecoin one-to-one with safe, liquid assets. And that move, right there, transformed stablecoins from a kind of risky bet into a real institutional-grade tool, like a super-fast version of the traditional banking system.
And what's pulling all this money in? There are 3 big magnets. First, you can actually earn a pretty decent yield on these things. We're talking 4.5% to 5.5%, because they're backed by things like treasury bills. Second, for a lot of the world, they're a critical way to protect against their own local currency losing value. And third, for the big players, the institutions, they've become the #1 place to park cash and ride out the market's ups and downs.
All right, now let's zoom in a little, because these huge macro forces are creating a really fascinating split down at the micro level. It's creating clear winners and losers among the smaller cryptocurrencies. And this tale of 2 very different tokens really shines a light on the market's new logic. So check this out. On one hand, you've got a token like Hooked Protocol, or Hook. Its value is getting totally crushed by bad sentiment and a lack of access. But on the other hand, you have Unitas, or UP, and it's actually thriving because its value is tied directly to real on-chain revenue and actual utility. It is the perfect story of hype versus substance.
So let's look at the bear case first with Hook. It got delisted from major exchanges, which just destroyed its liquidity. The whole market is in extreme fear mode, which means high-risk tokens like this are the first things people sell. Its price is cratered, down over 65% in just a month, and all the technical charts are screaming sell. It's just a perfect storm of bad news. But then, in complete contrast, you have UP. Its value comes from real money the protocol is earning,
which could share directly with the people who hold and stake the token. It has over $80 million locked up in it, which shows people are actually using it. It's getting listed on new exchanges, which is boosting its liquidity. So you see the difference? Its success is tied to real, measurable growth, not just hype.
Okay, time to be a detective. We've got all the clues laid out. Let's put them all together, solve this paradox, and figure out what the market is really trying to signal with all this weird behavior.
The key metric we need to look at is something called the Stablecoin Supply Ratio, or SSR. Now, it sounds complicated, but the idea is actually super simple. It just compares the total value of Bitcoin to the total supply of stablecoins. And when that ratio, the SSR, gets low, it means that pile of stablecoin cash has enormous buying power compared to the size of Bitcoin.
And wow, look at this chart. It shows the SSR is at lows we have not seen since late 2023. And what happened right after that? A massive, epic bull run. This is what you call a bullish divergence. It suggests that Bitcoin is seriously undersold compared to the sheer amount of cash that is sitting there ready and waiting to buy it.
So, what's the big takeaway here? This is not what a dying market looks like. Not even close. This is the profile of a market that is reloading. You can almost picture it like a giant coiled spring of capital, just getting tighter and tighter, waiting for some kind of trigger.
And that really leaves us with this final, powerful idea that just perfectly sums up the tension in the market right now. The spring is coiled. The only question is when it will be released. The money's there. The buying power is at an all-time high. The only real question left is, what's going to be the spark?